What if everything you've been told about interest rates was wrong? What if the promise that rates will fall, that relief is coming, is not a delay, but an illusion? Because for years, we've been told the same story, that high interest rates are temporary, that central banks will step in, that the pressure will ease, just like it always has. And yet, it never quite happens. Not when expected, not at the scale promised, not without consequences that ripple far beyond what anyone admits. Behind those promises stands the authority of institutions like the Federal Reserve, entities that don't just influence the economy, but shape how we perceive it. When they speak, markets move. When they hint, billions reposition. And when they promise, people believe. But belief in financial systems is dangerous, because interest rates are not just numbers. They are the price of money itself, the cost of borrowing from the future to live in the present. When rates fall, money becomes easy, cheap, accessible. Loans expand, spending accelerates, markets rise. But here's what most people don't see. Lower rates don't create wealth. They pull it forward. They borrow growth from tomorrow and spend it today. And for a while, it feels like prosperity until the bill arrives. To maintain stability, the system relies on a powerful idea that it is under control, that institutions like the Federal Reserve can adjust the economy like a machine, raising rates to slow things down, lowering them to stimulate growth. Precise, calculated, predictable. But that perception hides something deeper, because the most powerful tool central banks use is not action, it is communication, a strategy known as forward guidance, a signal about the future carefully crafted to shape behavior in the present. When they say rates will fall, people act as if they already have. Investors take risks, businesses expand, consumers delay caution, entire markets move based on words. But words are not reality. And when reality refuses to cooperate, when inflation persists, when growth doesn't slow, when the system reacts in unpredictable ways, those promises begin to break. Quietly at first, then repeatedly, until something more fragile begins to crack. Trust. But to understand why this keeps happening, you have to look deeper, at the foundation itself, because the modern economy is not built on productivity alone. It is built on debt. Governments borrow, corporations borrow, consumers borrow, and since the 2008 financial crisis, that borrowing has exploded. What was once a tool became a necessity, because debt doesn't just exist, it must be serviced. Every dollar borrowed carries a cost, and that cost is interest. When rates are low, that burden is manageable. But when rates rise, everything changes. Payments increase, margins shrink, fragility spreads, and suddenly, the system begins to strain under its own weight, which creates a dangerous dependency. Because lowering rates is no longer a choice, it becomes survival. But here's the paradox: lower rates solve the pain, temporarily, while quietly making the problem worse. Then came the turning point, the moment the rules changed. During the 2008 financial crisis, central banks did something unprecedented. They began creating money, at scale, through a process called quantitative easing. Not by printing physical cash, but by digitally injecting liquidity into the system, buying assets, suppressing yields, forcing interest rates down across the entire economy. At first, it was temporary, an emergency response. But it never stopped, because markets adapted. They grew dependent. Asset prices rose not always because value increased, but because money became abundant, cheap, almost effortless. And this changed everything. Money was no longer neutral. It became policy, a lever, something that could be adjusted to sustain the system. But every intervention carries a cost, and that cost was hidden until inflation arrived. At first, it seemed harmless, a small increase in prices, a temporary imbalance. But inflation is not just rising prices. It is the erosion of money itself. When more money chases the same amount of goods, value begins to distort. Prices rise, not because things are worth more, but because money is worth less. And then something even more dangerous happens. People begin to expect it. They spend faster. Businesses raise prices sooner. Workers demand higher wages. And in doing so, they create a feedback loop, a cycle where belief becomes reality. After the COVID-19 pandemic, this cycle accelerated. More money, fewer goods, rising expectations, and suddenly, inflation was no longer temporary. It was structural. Now the system faces a constraint it cannot escape. If rates fall, inflation returns. If rates rise, debt begins to break. This is the interest trap, a system locked between two opposing forces. And the deeper you look, the tighter it becomes, because even small increases in rates now ripple across trillions of dollars. A 1% shift is no longer marginal. It is systemic. It changes everything. And nowhere is this more visible than in the markets. For years, markets operated on one assumption. Money will always be cheap. Capital flowed freely. Companies grew without profit. Valuations expanded beyond fundamentals. And indices like the Nasdaq Composite became symbols of a new reality where future potential mattered more than present performance. But this created something deeper than growth. It created addiction. An expectation that every downturn would be rescued, that every crash would be reversed, that liquidity would always return. But when rates rise, that illusion begins to break, and what was built on cheap money cannot survive expensive money unchanged. Behind all of this lies another force, politics, because lower interest rates are not just economic tools. They are political advantages. They stimulate growth, reduce borrowing costs, create the appearance of stability. But the economy does not follow election cycles. It follows constraints. And when inflation rises, those constraints tighten. Central banks are forced to act, even when the consequences are uncomfortable. And so policy becomes a compromise between what is necessary and what is convenient. And yet, despite everything, people still believe that rates will fall, that the system will return. Because the human mind is not built for abrupt change. We rely on patterns, on history, on the assumption that what happened before will happen again. But this time, the structure is different. The conditions have changed, and the belief itself has become part of the risk. So what does this mean? It means the question is no longer, when will rates fall? The question is, what if they don't? What if this is not a phase, but a new reality? Because in a world where money is no longer cheap, everything changes. Cash flow becomes survival, debt becomes weight, risk becomes exposure to false assumptions. And the greatest danger is waiting for a system to return to something it can no longer be. Because in the end, the interest trap is not about interest rates. It is about belief. Belief in control. Belief in cycles. Belief in promises that were never guaranteed. And those who continue to wait may never realize that the system already moved on without them. If you've watched until this point, you already understand this is not just about interest rates. It's about a system that moves differently than what most people are prepared for. The question is not whether you agree. The question is whether you're positioning yourself for what comes next. So I want to ask you one final thing. If rates never return to what people expect, what do you think happens to the world next?